After going through this chapter, you will be able to understand the concept of valuation of equity shares, know the methods for valuing shares, comprehend the role of dividends in share valuation, appreciate how knowledge of future earnings can be used by investors. In this module, we shall study about the valuation of securities, equity shares. Every company needs a lot of funds to do business. For this, company takes the help of public. Issuing shares to public is one of the ways to generate funds from public for doing business. Whenever someone buys shares from a company, he gets a share certificate in return. There are basically two kinds of shares, namely equity shares and preference shares. Section 43 of the Companies Act 2013 explains that there are two kinds of shares issued by companies. A. Equity shares. B. Preference shares. Understand the concept of equity shares. The Act defines equity shares for a company limited by shares to be shares which are not preference shares. They are of following types. First, equity shares with voting rights. Second, equity shares with differential rights. These differential rights can be with respect to dividend, voting or in accordance with such rules as may be prescribed. Preference share capital. Preference share capital is those capital which carry preferential rights. These preferential rights can be for following. First, preferential right in payment of dividend. A preference shareholder has the right to get dividend as fixed amount or at a fixed rate. Dividends to them are paid before they are given to equity shareholders. Second, in case of winding up or repayment of capital, again preference shareholders will be paid first. In this chapter, we are interested about calculating the value of equity shares. So, let us discuss about valuation of equity shares. The value of equity shares can be finding on the following basis. Valuation on the basis of accounting information, valuation on the basis of dividends, valuation on the basis of earnings. Valuation on the basis of accounting information. Accounting information is also a good source to get the value of equity shares. Accounting information may refer to any such information that can be ascertained from the accounts of a company. Balance sheet is one of the means through which value of equity shares can be ascertained. The following values of equity shares can be ascertained from accounting information. Book value of shares. The book value of share is the one which is based on the information derived from the book of accounts of the company. Balance sheet is a financial statement which provides data for calculating the value of equity shares of the company. The value of equity share is calculated by dividing the net worth of a company by the number of outstanding equity shares. Net worth of a company is obtained as follows. Net worth is equal to equity share capital plus reserves and surplus minus accumulated losses. Therefore, we can find book value of equity shares as follow. It is equal to net worth of the company divided by number of equity shares, which is equal to equity share capital plus reserves and surplus less accumulated losses upon number of equity shares. By this formula, we get the value of per equity share of the company from the information resulting from the balance sheet. For example, if a company has the net worth of rupees 10 lakh and the number of outstanding equity shares are 10,000, then the book value of equity shares will be rupees 100 each, that is 10 lakh divided by 10,000. The book value of equity share is not a good indicator of shares worth as it is based on the historical data of equity share value, reserves and surplus and accumulated losses. Liquidation value. Liquidation value is that value which is based on the fact that in case a company liquidates, then its asset will be realized for some value. The value or the amount of money received from the sale of assets will be utilized for the payment of secured and unsecured liabilities as well as preference shareholders. Now, if any amount of money is left after the payment for settlement of claims of all the above mentioned sources of fund, this will be given to equity shareholders. Thus, liquidation value of equity shares will be obtained as follows. Liquidation value is equal to realized value of assets less payment to be made to secured and unsecured creditors less payment to preference shareholders divided by number of equity shares. Liquidation value is a better measure than book value as it is based on current realizable values than historical values. But again, it has problems. First, it is not easy to determine the realizable value of assets. Second, it is not based on earning capacity of the firm. Next, valuation on the basis of dividends. Dividends can be explained as earnings of the equity shareholders. It refers to the portion of company's profit or retained earnings being given to equity shareholders. As we all do some or other kind of work with the expectation of some benefit from that work, similarly, shareholders invest in equity of the company with the expectation of dividend or gain from increase in market value of that equity. Therefore, it is argued that value of a share is based on the present value of future expectation. The value of the stock is the present value of all future cash flows that will accrue to that investor in the stock. Thus, the value of share today is got by discounting of future cash flows. This can be expressed as follows. P0 is equal to D1 upon 1 plus KE raised to the power 1 plus D2 upon 1 plus KE raised to the power 2 till D infinity upon 1 plus KE raised to the power infinity. The dividends can be of following types: zero growth dividend, constant growth dividend, variable growth dividend. Valuation of equity share for zero growth in dividends. Zero growth dividend means that the shareholder will receive the same amount of dividend every year. If same amount of dividend is received every year, then it is like perpetuity. This means that dividend will be same for year after. That is, dividend after 1 year will be equal to dividend after 3 years or dividend after 7 years. The value of share in such a case will be determined on the basis of rate of return on equity and dividend received. Thus, share price will be calculated as follows. P0 is equal to D upon KE, where P0 is the current price of share, D is the value of dividend to be received every year, KE is the cost of equity. Example, a company has announced the dividend to be rupees 10 for every year. The investors expect to earn a rate of 5% on their investment. Find the current price of the share. Solution. This is the case of zero growth dividend as the amount of dividend to be paid is same every year. So, P0 is equal to 10 upon 5% which is equal to 200. Therefore, price of equity share is rupees 200. Valuation of equity shares in case of constant growth dividend. In case dividends of a company grow at the same rate every year, then we can take out the value of equity by discounting the dividend that a shareholder will receive next year. The amount of dividend that will be received next year can be calculated on the basis of value of dividend of the previous year and the known growth rate. The technique for valuing shares in such a case was given by Myron J. Gordon. Therefore, this model is also known as Gordon growth model. According to this model, the value of shares can be calculated by using the following formula. P0 is equal to D1 upon KE minus G, where P0 is the current price of share, D1 is the value of dividend expected to be earned in the next year. It is calculated on the basis of D0 and G, that is D1 is equal to D0 into 1 plus G. D0 is equal to dividend declared last year. KE is the cost of equity. G is equal to growth rate. For example, ABS Limited paid the dividend of rupees 5 in the last year. The company has a growth rate of 5% and the required rate of return is 12%. Find the price of share. Solution. Here, let P0 is the current price of share. D1 is equal to 5 into 1 plus 0.05, which is equal to 5.25. KE has been given to you 0.12. Growth rate is equal to 0.05. Then the current price of share will be P0 is equal to 5.25 divided by 0.12 minus 0.05, which is equal to rupees 75. Next, valuation of equity shares in case of variable growth dividend. The above two methods for valuation of shares based on dividends are rare to see in practical life. In reality, the dividend from a company may show one growth rate for few years and some other growth rate for other years and some other growth rate for some other period. In such a case, the present or current value of equity will be based on present value of all such different expectations. Valuation of dividends on the basis of earnings. Many firms may see various opportunities to be captured in future time to increase the earning capacity of the company by investing in some kind of project. But the biggest problem of such an opportunity is the need of funds to be invested in it. For that, many companies resort to financing through retained earnings. These earnings are the ones which are retained by the business. In other words, the amount of profit which would otherwise be available to be distributed as dividends to the shareholders is called as the earnings. And when these earnings are divided by the number of shares, then it is called as earning per share. There are different approaches to find out the value of equity shares on the basis of the earnings of the company. These are Gordon model, Walter model and price earnings ratio approach. Let us now discuss the Gordon model. One very popular model clearly relating the market value of the firm to dividend policy is developed by Myron Gordon. He explained that either company will distribute its profit as dividends or it will retain them for investing purpose on the basis of availability of projects in future. Assumptions of Gordon model. Following are the assumptions on which the Gordon model is based. First, all the financing needs of the firm are met by issue of equity shares. Second, there are no loans and debentures. In short, there is no external financing through borrowed funds. Third, the internal rate of return R of the firm is constant. Fourth, the appropriate discount rate KE of the firm remains constant. Fifth, the firm and its stream of earnings are perpetual. Sixth, there are no corporate taxes to be paid by the firms. Seventh, the retention ratio B once decided upon is constant. Thus, the growth rate G is equal to BR is constant forever. Eighth, KE is always greater than BR, that is KE is greater than BR is equal to G. If this condition is not fulfilled, we cannot get a meaningful value for the share. According to Gordon's dividend capitalization model, the market value of a share P0 is equal to the present value of an infinite stream of dividends to be received by the share. Thus, P0 is equal to EPS into 1 minus B upon KE minus BR. The above equation explicitly shows the relationship of following in the determination of the value of the share P0. Current earnings EPS, retention ratio B, rate of return on reinvestment R and the all equity firm's cost of capital KE. Example, a firm has earnings per share of rupees 10, its retention ratio is 80%, the return on investment is 25%, the cost of equity is 15%. Find the value of share. Solution. P0 is equal to EPS into 1 minus P upon KE minus BR. Here, current earnings, that is EPS, is equals to 10, retention ratio B is equal to 80%, rate of return on reinvestment R is equal to 25%, and cost of capital KE is equal to 15%. Putting in the formula, we have P0 is equal to 10 into 1 minus 0.80 divided by 0.15 minus in bracket 0.80 into 0.25, which is equal to rupees 40. Next, moving on to Walter model. Professor James E. Walter gave a model that supports that the value of share is found by adding the value of infinite stream of dividends and return from retained earnings. His model shows clearly the importance of the relationship between the firm's internal rate of return R and its cost of capital K in wealth of shareholders. Walter's model is based on the following assumptions. First, all the financing of the firm is done through retained earnings. There is no debt or new issue of equity. Second, the firm's internal rate of return R and its cost of capital K are constant. Third, all earnings are either distributed as dividend or reinvested internally immediately. Fourth, EPS and dividend per share remain constant. Fifth, the firm has a very long or infinite life. Walter's formula to determine the market price per share P is as follows. P is equal to D upon KE plus R into E minus D upon KE whole upon KE. For example, ABC Limited has cost of capital KE of 10%, earnings per share E is equal to rupees 10, rate of return on investments R is equal to 8%. The dividend payout ratio is 50%. Calculate the market price of the shares. Solution. The market price of the share can be found by applying the following formula. DP ratio is equal to 50%, EPS is equals to rupees 10. Therefore, according to DP ratio of 50%, dividend per share, that is D, is equal to 10 into 50%, which is rupees 5. I repeat, so price of the share is 5 plus 0.08 divided by 0.10 into 10 minus 5 whole upon 0.10, which is equal to rupees 90. We shall now discuss the price earnings ratio. The price earnings ratio can be understood as the price for a stock that an investor is paying for rupees 1 of a company's profit. In other words, if a company is reporting that the earning per share is of rupees 2 and the stock is selling at a price of rupees 20 per share, the price earnings ratio is rupees 10, that is rupees 20 per share divided by rupees 2, resulting in earnings per share, which is equal to 10 P upon E. The price earning ratio is usually written as P upon E ratio. To find out the value of an equity share, we have to multiply the EPS earning per share with the PE multiplier or the price earning ratio. But here it becomes important to understand how PE ratio is determined. Generally, it is computed by dividing the current stock price by earnings per share for the most recent 12 months. It is followed so closely because it relates the market's expectation of investors about the performance of the company in future, embedded in the price component of the equation, to the company's actual recent earnings performance. The greater the expectation, the higher a multiple of current earnings investors is willing to pay for the promise of future earnings. Thus, the value of share can be determined if we know the following. EPS, that is earnings per share, PE ratio or price earnings ratio. Value is equal to EPS into PE ratio. Example, a company has EPS of rupees 20, its price earning ratio is rupees 2, find the value of the equity in this case. Solution, value is equal to EPS into PE ratio, which is equal to 20 into 2, which is equal to rupees 40. Let us now recapitulate what we have learned so far. Equity shares are one of the main sources of any company's finance. The present value of any equity share is basically the reflection of people's attitude towards such shares or expectation from such share in future. Thus, the value of equity share can be determined by discounting the expected future value from such shares. There are various methods to get the value of equity. These methods are based on various factors such as dividend paid or to be paid by the company, earnings of the company, or through accounting information. All this information helps an investor to make a proper decision regarding the value of share. In order to find out the fair value of the shares, an investor may make use of two or more than two methods of valuation. Thank you.